And let's get some more on what to expect at the Open. Chris Weston joins us from IG Markets now in Melbourne. Chris, good to see you and a lot to ask you about too. Just firstly, the US jobs numbers. The headline reads stronger than expected, but the rest of the report, parts of it certainly quite negative there. It was strange watching the way that the market reacted to that data. Does it take QE3 off the table or is it still there?
Well, I mean, I think the barriers to entry have picked up a little bit now. I think this to me shows the psychology of the market, Bridie. I mean, we've got a market which has been so long, just had so much bad news being thrown at it. The fact that everyone looked at the headline number, which was 163,000, I think the average over in the second quarter has been 73,000, so it's significantly above the expectations and significantly above the average as well. So, yeah, if you look at the euro, for example, as a proxy, well, we saw it rallying quite nicely going into the release on some of the situations we're seeing within Spain, you know, potentially requesting this bailout, which is part of the bigger picture of what we're going to be seeing over there. And then the headline job numbers certainly smashing expectations. People bought into the idea of risk on. It doesn't take it off the table. I mean, you've got to look at the other parameters as well. We've got the ISM manufacturing still below 50. The hours worked, the hourly earnings were only up 0.1%. The market was looking for 0.2. So clearly the personal income numbers further down the line are going to suffer a touch. And I think as well, you know, some people are crediting to a lot of this strength to seasonal factors in the restaurant space, seasonal factors in some of the car automator side of things as well. So perhaps we're going to get a bit of payback in the next meeting, plus the fact that we saw last month's being revised down a touch as well, taking away some of the quality around this release as well. I think what we did see, Reuters coming out with an article straight after the release, they interviewed 16 of the primary dealers. These are the guys that deal directly with the Fed. Now, they still, 63% of them still see QE3 being administered sometime, probably around the September meeting, using the Jackson Hole meeting on August 31st as that soundboard or sounding out the market and giving that sort of signal. So the primary dealers, the guys who know the Fed very well, are still calling for QE3. I'm still a little bit reluctant. There are signs that US data is stabilising since the 19th of July. And I think perhaps the use of the discount window could be a very important situation where they're actually going to incentivise lending by the banks rather than actually going out and doing unadulterated QE3 asset purchases. Perhaps they're going to go to banks and say, look, you come to us, we'll give you zero interest loans effectively if you meet a certain lending criteria. That wouldn't be so dollar negative given the fact that there'd be collateral agreements in place. That could be quite feasibly done as opposed to unadulterated asset purchases at the moment. But yeah, good numbers. I think it just shows the market was searching out good news.
Interesting too, though, I guess, with the presidential election just a few months away, and we had the Republican candidate Mitt Romney out there telling CNN, you know, we don't think the Fed should use new stimulus measures. The first two QE efforts didn't work. It's a tough act for the Fed, isn't it, to try and act without being seen either way to be following either political party.
Yeah, it's just a great point you make there, and you know, Mitt Romney's, of course, he's going to say these comments. I mean, at the end of the day, if we did see Bernanke and come out and initiate a $500 billion or to 700 billion of asset purchase, mortgage-backed security purchase, US Treasuries, you are going to see the sugar high coming through in equity markets. There's no doubt about that. You're going to see equities, the S&P, push quite convincingly up to the sort of well above the 1400 level where we are at the moment. You know, you're going to see good gains. What happens there? People become more confident because their 401 portfolios suddenly become a lot stronger, and they feel a bit more optimistic about where the economy is and about the government that's currently in charge. So clearly, if we did see an asset purchase program that close to the election, people would feel more compelled about their current financial state, and of course they'd be more inclined to vote for Obama. So yeah, I think it's obvious he's going to be doing that. But I point out that the services ISM number on Friday was still in expansionary territory. That's something they're going to be looking at. You're going to see the consumer confidence numbers still quite strong at the moment. The housing numbers are okay. The May house price index was up 0.9%. If you look at the Citigroup Surprise Index, now this is an index which basically tracks consensus of amongst the economists and actually against what the actual print, the employer or the data print against the consensus. Obviously, if the index is going up, it shows that the actual prints are beating the expectations of the market. Now, the Citigroup Surprise Index at the moment is about -35. If you look back to July, beginning of July, that was around -65. So in that time, you have seen the US data actually start to improve, and I think that perhaps takes some of the shine off the QE3 trade at the moment.
Just got to ask you about Europe as well, and also try and figure out what's kicked off this rally? Because certainly we were talking to Mark Bailey from Equasia earlier, and he was talking about how he's struggling to see what's behind it. But certainly looking at the jawboning that the ECB President Mario Draghi's been doing, is that what's happening here? Is he just trying to talk it up, the indications of what they might do if they have to, and it's clearly working?
I think he's doing a fantastic job, to be honest. I think on Thursday there was a lot of people calling about Mario Draghi's credibility, and what he's done is he's won over most of the European Union, with the exception of the Germans. And there was a lot of focus on that over the weekends about different people like Jürgen Stark saying that the ECB is losing its credibility. They shouldn't get involved in this type of monetary policy actions. Their job is price stability. But the Finns, the Austrians, these guys are generally very much anti-bond buying. They seem to be on board with this. Even Merkel seems to be on board with this at the moment. So what he's done is he's done this great situation where he's kept the market guessing, are we going to get sterilised or unsterilised bond buying? Are they going to take a dollar out for every dollar they put in? Expansion of the monetary supply. Are we going to see QE? If we see unsterilised bond buying by the ECB, that would be euro negative. It's just like what would happen with the Fed. That would be a very big positive. We don't know the size of this action that's going to take place, and he's actually put the onus now very much on the governments, and he's targeted a certain part of the yield curve as well. So I think what he's done here is a very, very big positive. The next big positive is what's happening in Spain. Spain are coming out and saying, look, we want our yields to be lower where they are. We need to raise something like 200 billion euros in the bond market next year and the year after. When you've got front-end yields, which is where they're raising all their funds at, trading at 5, 6, 7% at some stages, we will perhaps take our action. And Mr. Rajoy came out over on Friday saying that perhaps it's in the best interests to actually apply for this assistance from the EFSF and the ESM to actually go buying bonds in the secondary market and the primary market, and backed up with what we're going to see from the ECB. It depends on the terms and the conditions. So that's one thing. You've also got the people within the EFSF themselves actually looking at the repo market, and that's actually giving the idea that perhaps they've only got 150 odd billion left in the kitty. Perhaps they could come out and leverage to actually buy more bonds in the secondary market as well. So there are signs at the moment that things are moving in the right direction, and he's put the onus back on the governments and saying that if you want borrowing costs to come down, you will need to apply for the conditionality. And I think personally that if this actually goes ahead, this could be a bit of a game changer longer term.
So this all sounds like it's boding pretty well for our market at the open in less than an hour. What's your opening call?
Well, we've got an open up about 1.5%, 1.6%. It's going to be a really strong day today, as we know. We have seen futures open a touch lower this morning, I think 6 or 7 points or so. So there's no real follow-through buying here in Asia. I think it's going to be one of those days which traditionally have been seeing where all the price action takes place in Europe and the US, and we just sort of pause for thought, given the fact that we've seen where risk assets have been. However, I'm hoping we're going to see a change of tact. Friday we saw the market coming a bit lower. People were questioning, saying that the ECB hadn't done enough, the Fed hadn't done enough. We wanted to see action here and now, and perhaps we're going to see a change of mentality. This is a fickle market. Perhaps people are going to say that they've done enough, and perhaps we are going to see the Spain tap this assistance thing, and we could see some follow-through buying. That's what I'm hoping. I hope we're going to see some follow-through buying today ahead of the earnings season here in Australia. We've got a big week in terms of company reports. Rio and Telstra are clearly the big ones to go with, and I think people have been very bearish in this. I mean, we've had 40 companies come out with their outlook statements and their guidance. So a lot of the weak people, the weak companies, the companies that we're going to really disappoint, they've come out of the market now. So perhaps we've been a little bit bearish into this earnings season, and perhaps we can melt up a little bit going forward. But yeah, I think it's diggers and dealers will be interesting to hear what some of the small cap stocks are going to be saying this week. But yeah, very strong day. BHP should see an open around about 2.8 or so% higher. So yeah, it's going to be a very, very strong day, which is great to start the week off.
So you don't think that any of these, I guess, as you mentioned there, these warnings coming through from a lot of those miners, including BHP, the Marius Klopper's even, talking about the fact he's not going to take his bonus this year, write-downs coming, and particularly on the US shale gas assets as it had been expected, worries about those commodity prices falling. You don't think that is going to perhaps weigh on that resources sector today at all?
Not today. I think it's something that the market is generally quite concerned about. We're going to obviously, I don't think it's necessarily going to see our market underperform. We're going to have a strong day, there's no doubt about that. But I think it's something that you do have to worry about. People are concerned with what's happening in the commodity super cycle at the moment. People are worried. You've got iron ore prices at 116. Are we going to start seeing them stabilise? Are we going to see producers cut back on production to try and see those prices stabilise? And of course, the demand side of things has actually been waning. Hence, a lot of these prices prices are under pressure, hence why Rio's and BHP's prices is making lower lows at the moment. So I think Rio will be very interesting this week just to see the capex charges there. It's something the market is focusing very clearly on at the moment. So yeah, I think it is something to be concerned with in the material space, that the demand side of things is slowing down. But I think today I don't think it's necessarily going to see these stocks open with any kind of headwinds. I think today's going to be a very strong day, led by what we're seeing in the US, and to me more prominently what we're seeing in Europe.
Good to hear, Chris. We'll chat to you throughout the session. Thanks so much for that.
Thanks, Bridie. Cheers.
Let's just stick with what the news coming out of the mining sector, and of course it is one of the biggest events on the mining industry calendar this week, the annual Diggers and Dealers